All right, let's take a deeper look now at what's driving the market gloom after yesterday's rate rise. The banking sectors, as Inez was mentioning, those difficulties showing how higher rates are having unintended consequences. Here with a look at how sectors are affected and how to play it safe. Paul Karger, TwinFocus co-founder and managing partner. Paul, good to see you here. So obviously a lot for investors to digest. You have the 25 basis point rate hike, you have core PCE still sticky, a strong labor market, and of course this nervousness in financial markets from all this banking fallout. What are you focusing on in terms of the biggest primary risk that your clients are asking about?
Sure. Great to see you, Rochelle. Thanks for having me. I think today the real challenge is the Fed seems to be in a bit of a bind. They're really trying to grapple with increased rates and, as you put it, the unintended consequences that's had on various sectors as that kind of rolls through the economy from commercial real estate and banking and so on, with the risk of inflation. And, per Powell's most recent comments on March 7th, they're really going to take it meeting by meeting, and ensure it's really data driven.
And I mean, part of that, we saw that Treasury Secretary Janet Yellen called for an unscheduled meeting of the Financial Stability Oversight Council this morning. A lot of people wondering sort of when some of these repercussions are going to work their way through the economy as well as markets as well. Do we have any insight yet about how long some of these repercussions might last?
Sure. Great question. It's going to take time. At this point, we believe the banking crisis is all been but mitigated by the Fed and the U.S. government and central banks actually around the world. They've come out and really backstopped these banks, perhaps at the risk of inflation, but nonetheless backstop them, trying to instill confidence in the economy. But it's going to take some time. At this point, it's really about confidence, and it's a perception issue, as we're seeing in the banks today. Higher rates are having a material effect on the economy. There's no doubt about it. Banks are bringing down leverage ratios and cost of financing projects are increasing. There's also the risk of companies that have debt rolling over, that they may have financed at significantly lower rates a few years ago. So the banks are going to have to work through this, and it's going to take time as it rolls through the economy.
So let's look for opportunities here. Obviously, for the road ahead for the Fed, it could be a pause, it could be a pivot, or leaving things unchanged. What do you do in terms of portfolio allocation when you're trying to sort of look down the road at each of these three scenarios?
Sure. We're really trying to encourage clients to really maintain this longer term view and really focus on those sectors that are providing kind of secular trends and try to avoid the timing risk. For more conservative exposures, we're really skewing towards an overweight in the U.S., kind of market weights in Europe, and an underweight to EM, the emerging markets, given growth and geopolitical concerns. In the U.S., we're focused on defensive and kind of inflation-sensitive sectors, things like consumer staples, which historically have provided exposures at kind of lower volatility, lower beta to the broader market. While they've lagged on the year to date, relatively they outperformed in 2022. Another sector we really like is utilities. Utilities again have lagged on the year to date, but have really outperformed in 2022, providing lower volatility, a higher cash flow component, and then of course healthcare, less cyclical. And really benefiting from the secular trends in demographics and kind of tech, the innovation and technology within the healthcare sector. Another sector we really like is energy. And we're using the most recent volatility to, again, focus on these longer term trends and to kind of pick off some of these energy exposures at this point.
And Paul, in terms of equities, what do you like right now and what are you steering clear of?
On a day-to-day basis, you mentioned technology and how portfolio managers are finding refuge in tech names, perhaps because tech and biotech has so been beaten down. So we do like tech. We don't get into naming individual securities at TwinFocus. We're really focused on kind of more macro allocation. But, again, we're looking to build exposures to these secular trends where we have weakness. We also like, on the fixed income side, obviously there's been a big push for clients pulling out of banks, as has been overly discussed here, where federal government is effectively competing for depositors and providing higher rates. So clients have certainly flocked towards treasuries, short-term treasuries. We think the risk there is that in a potential deflationary environment in the future, you could see rates come down and you have a reinvestment risk. So you may be able to lock in a 5.5% treasury for the next year, but we're encouraging clients to perhaps look a little bit further out in the curve.
So then, as you look at investor behavior at the moment, though, does it seem as if they're more so bracing for a pause at the next Fed meeting versus a pivot or anything else?
It's our feeling that Powell is going to continue to want to stomp out inflation. Again, it's going to be very data driven, but that's really kind of the signal that he sent to the market.